IAS 40 Investment Property. Derecognition Disclosure. This is a summary of the main content of IAS 40. Accounting treatment comprises recognition, measurement, and disclosure. This presentation will focus on derecognition and disclosure. Investment property will be derecognized on disposal or when no future economic benefits are expected from its continued use or disposal. Derecognition of a replaced part under the cost model. Where a component is replaced, the cost of the new component is capitalized and the replaced part needs to be derecognized to prevent overstatement. This is exactly the same principle as under the cost model of IAS 16. But what if the replaced part had not been identified and measured and recorded and depreciated separately? You still need to derecognize something. How do you determine the carrying amount to be derecognized? You calculate what is referred to as a deemed carrying amount, where you use the cost of the replacement as an indication of what the cost of the replaced part was at the time it was constructed or acquired. Derecognition of a replaced part under the fair value model. The fair value may already reflect that the part to be replaced has lost its value. In other cases, it may be difficult to determine by how much the fair value should be reduced for the part being replaced. An alternative would then be to include the cost of the replaced part in the carrying amount of the investment property and then to reassess the fair value. This would prevent overstatement of the investment property. Derecognition of investment property in an asset realization account. If you apply the fair value model, there will not be accumulated depreciation and you will just have to derecognize the asset's carrying amount. If this asset is now sold, you compare it against the proceeds and you have a resultant profit or loss. Compensation from third parties for investment property that was impaired, lost, or given up shall be included in profit loss when the compensation becomes receivable. The following is identified as separate transactions that have to be disclosed separately: the impairment of investment property under the cost model, the derecognition of investment property, compensation received from third parties, cost of item restored, purchased, or constructed. Presentation and disclosure. On the statement of financial position, investment property is presented under non-current assets, not property, plant, equipment, investment property. So it is presented under assets and non-current assets. In the statement of profit or loss and other comprehensive income, other income and other expenses will be affected through your fair value adjustments. Please note, there are no other comprehensive income items coming through from IAS 40. In the statement of changes in equity, there will not be a revaluation surplus relating to investment property. All fair value adjustments is recognized through profit or loss for the year and would therefore affect retained earnings. In the statement of cash flows, cash generated from operations and cash flow from investing activities are affected. Cash generated from operations. Depreciation, when you're applying the cost model, is a non-cash flow item. Profit or loss from disposal, as well as a fair value adjustment when you apply the fair value model, is non-cash flow. The replacement of investment property will fall under cash from investing activities as investments to maintain operating activities. Additions to investment property and proceeds on disposal of investment property will fall under investments to expand operating capacity. Please note, fair value adjustment is a non-cash flow movement on your investment property account. This is an example of an accounting policy note for investment property. The IAS 40 identifies very specific disclosure requirements in your profit before tax note. These include rent received from investment property, fair value adjustment, gain or loss. Fair value adjustment, gain or loss usually form part of your investment property note as well. The reason why it will be included in the profit before tax note is because if it's material, it is expected through the requirements of IAS 1. A further specific requirement in IAS 40 is to disclose direct operating expenses relating to your investment property. These have to be further distinguished as follows: direct operating expenses relating to investment property generating rental income, or direct operating expenses relating to investment property not generating rental income. These amounts are usually given in a question, and it is expected from you to know the way in which it has to be disclosed separately. This is an example of an investment property note under the cost model. It looks very similar to the property, plant and equipment note under the cost model of IAS 16. Few features to highlight. You have a separate column for land and a separate column for buildings. The movement between the opening carrying amount and closing carrying amount is similar to that in IAS 16. What is, however, a bit different is the following. IAS 40 requires you to distinguish under additions between acquisitions of new investment property and subsequent expenditure capitalized on existing investment property. Because it is investment property, the fair value of the land and buildings will also have to be disclosed in this note, even though you apply the cost model in this instance. This is an example of your investment property note when you apply the fair value model. Please note, fair value is usually determined for the property as a whole, and the fair value therefore includes the value of the land and the buildings. Therefore, you only have to show one column. It will be incorrect to show two columns. In this note, there is a reconciliation between the opening balance and the closing balance of your investment property. Current year movements would include items such as additions. Again, your additions needs to distinguish between acquisitions of new investment property and subsequent expenditure capitalized to existing investment property. And then you would have as a separate line item your net loss or gain from fair value adjustment. At the bottom of this note, you include narrative information regarding the independent sworn appraiser that determined this fair value.